Hi, my name is Kate. Today we're going to discuss on 4 basic assumptions of accounting, 6 basic accounting concepts, and 4 modifying principles of accounting. Let's first discuss basic assumptions of accounting. Accounting entity assumption. The assumption states that the business transactions are separate from the owner's personal transactions. For example, Sam, Alex and Ken runs a business on shares of 25, 35 and 40% of profits. And the business is on loss now, but they are only liable to this loss for the percentage of shares they own. Next assumption is money measurement assumption. Money measurement assumption states they record only those transactions which can be recorded in terms of money. For example, Daniel purchased a building for his business use, so he'll record this event, but he'll not record that the building is in small town or in a big city. Going concern assumption. As per this assumption, businesses will last forever and will not wind up in near future. For example, Sam assumes that his hotel business will run for years. Accounting period assumption. Accounting period assumption states that to divide up the complex, ongoing activities of a business into periods of a year, quarter, month, week, etc. For example, Alex closed books of accounts in a year. Let's now discuss about basic concepts. First concept is dual aspect concept. The concept states that every business transaction requires recordation in 2 different accounts. For example, Sam purchases furniture for his hotel. He paid cash to receive furniture. Revenue realization concept. Revenue realization concept states that revenue can only be recognized after it has been earned. For example, Daniel sold some chocolates to his friend Neil on credit. Here goods have been delivered and Daniel records this in his book of accounts. Historical cost concept. Historical cost concept states that the price of an asset on the balance sheet is based on its nominal or original cost when acquired by the company. For example, Sam purchased his hotel for $1 million 5 years ago, entered in books of accounts, and this original cost will be shown same $1 million even after next 10 years in the books of accounts. Matching concept. Matching concept states that write only relevant cost of the period. Revenues are reported along with the expenses that bought them in same period. For example, Daniel purchased a building $252,000. That will be useful for 80 months. Here the company will match $3,000 of expense each month to its monthly income statement. Full disclosure concept. Full disclosure concept states that you should include it in an entity's financial statements or information that would affect a reader's understanding of those statements. Example, the nature of non-monetary transaction. Verifiable and objective evidence concept. This concept states that transaction should have adequate evidence to support it. For example, Daniel purchased truck for his business use, then it should be visible in his business land. Now, let's look at modifying principles. First principle is cost-benefit principle. Cost-benefit principle states that the cost of any event should be less than the benefit of that event. For example, Neil plans to open a new business, and he paid $100,000 to experts for setting up plan for his new business. Then the plan should give benefit of more than $100,000. Materiality principle. This principle states that an accounting standard can be ignored if the net impact of doing so has such a small impact on the financial statements that a reader of the financial statements would not be misled. For example, Daniel spent $10 to buy a wastebasket that has a useful life of 10 years. The materiality principle allows him to expense the entire $10 in the year it is acquired instead of recording depreciation expense of $1 per year for 10 years. Consistency principle. Now, this principle states that once you adopt an accounting principle or method, continue to follow it consistently in future accounting periods. For example, Neil purchased machine and use written down value method of depreciation for this year, so he must to follow the same for next coming years. Prudence Principle. So, the last principle of accounting states that do not overestimate the amount of revenues recognized or underestimate the amount of expenses. For example, Daniel thinks that Neil will not be able to pay his money back, then this is a loss for Daniel, so he'll record this in books of accounts. But suppose Daniel think that he'll earn twice the cost of the chocolates when he'll sell rests, then he'll not record this in his books, as this profit is not yet earned. Thanks for watching. We hope this video was helpful. Please subscribe our channel for more accounting related videos. If any doubts, you can comment below or can post on our Facebook page.